Hi, Paul Gerard from Price Accounting Services, and welcome to this further video in our investor series. In this one we're going to talk about employee share scheme interests, ESSs. Okay, an ESS occurs when an employer provides an equity benefit to employees at low or no cost. Okay, ESS schemes vary a lot, okay, but there are some common issues and we'll address these in general terms. We're not here to provide you with guidance and advice in respect of your holdings, okay? If you do have that issue, we welcome it. Okay, the first one is the exempt employee share scheme discount schemes. These are common to some Australian listed employers who may give or offer a general scheme for up to $1,000 value of shares to all employees. Commonly, the employee might be able to salary sacrifice, so whilst they're not giving them, you get it in a tax beneficial manner and you end up having an interest in your employer. For tax purposes, there's a scheme. This scheme is treated differently depending on your taxable income. So for an employee earning under $180,000 a year, up to $1,000 of that benefit, receipt of those shares, is tax-free. So the salary sacrifice effectively is tax-free income, which makes it very attractive. But then there's others which are Ess Deferral Schemes. So an Ess Deferral Scheme generally applies to schemes where only some of the staff are provided benefits, and it could be an executive scheme or a specialist board members of the like. They vary enormously, but commonly the discount on the issue is deferred until a qualifying event occurs. Qualifying event may be the shares vesting or losing restrictions on trading or forfeiture, or cessation of employment, or after a time period, i.e. 15 years, is a common rule now, but prior to 2015 it was 7 years. So commonly on the vesting date for these deferral schemes, the company will value the discount value of the shares. So what do I mean by that? So let's say you work for a bank, ABC Bank, and the listed value, well, the company issues you with employee shares, 10,000 employee shares issued on a loan basis, and they're all being restricted until a vesting date, and the shares are valued at the deferred valuation point, so in other words on the vesting date. So they might have been issued to you for nothing 5 years ago, and now they're vesting as an unrestricted tradable security that you can take control of, and they're worth $10. Well, that $10 per share will be assessed to you as taxable income, and you'll be provided an ESS payment summary. Now, it's important to remember that plus any amount you might have paid for the original interests will be your cost base for your shares. So that's an important record keeping matter, to keep a continual track of the cost base of your ESS interests, because they will become entitled or issued on different dates. They might have a different vesting date, might be relevant what the income value was that was used to determine the cost base, and so forth. So keep great records. Alternatively, we can do so for you, and we do so on request. Employers that issue share options, however, will vary as well. So some employers might issue an employee an option to acquire shares. Now, the options might in themselves be valued in a different way, and so each scheme does need to be appraised and assessed on its own merits, and there are specialist advisors in this area. Sometimes we get clients where the ESS scheme is very simple to understand, in other cases very complex to understand. Some of them are also determined by the company following very comprehensive tax advice, and they may have variations which are based on foreign ownership, local ownership, all sorts of things. But bear in mind one key difference for options versus shares. The option scheme comes with one problem, that is, when an option is exercised, it starts a CGT clock all over again because the options are different to the share. So the options give rise to an entitlement to buy shares on the cheap, which might be valued as a discount, but you've still got to outlay the cash, and then your 12-month CGT clock starts from that point. So bear that in mind. But every company will generally issue the employee with general guidance on their specific scheme and the tax consequences, and that's important to read and understand. Some of them are very extensive. Now I'm going to give you a tax tip here for employees who receive vested ESS discounts. So those ones who get the PAYG summary, this is the ESS PAYG summary, people. There can be a benefit where you know the vesting date. For example, it might be an annual date, 31st of March of each year, that your shares issued 3 years earlier vest after 3 years and convert from being restricted stock units in the Amazon example, US example, to being an unrestricted share. What that will mean is on that date, you will get that they appraise the value of the ESS discount, and that becomes taxable income. The strategy here is, on that date, disposal of that very same interest to a trust might be a tax strategy to consider. Why? I say it because on that date, that's the valuation date for the ESS interest, and it's based on the market value on that date. So if you dispose at market value to a related entity, yes, you will trigger a CGT event, but it's zero because your cost base is what you paid on that day. So it gives you the ability, if you believe that those shares will have a higher future value, and I'm using an example of maybe an Amazon employee. I've seen it with Microsoft employees in the US, where by deferring the income, you then trigger the ESS discount on that same date. So by selling on that date, no CGT amount occurs despite a CGT event, and it means the trust then holds for the foreseeable future. That may produce a tax benefit where there's an expectation of future income or capital gains from those shares to be maybe split with other family members, such as a non-working wife. So I raised that as an issue for you to consider. I've seen a great number of people use this method, and it can sometimes produce a benefit. So that the CGT benefits then sit in the trust, so non-working spouses, etc. But remember, the 12-month CGT rule will start again compared to if they're retained in your own name, because remember, the CGT clock for those shares would have started maybe 3 years ago when the shares were issued. They're valued at the vesting date, but they're still subject to discounts, just that there's no value to discount. So you've just got to weigh up the merits of how long you expect to hold them. Okay? So I hope that's been helpful, and that covers employee share scheme interest, which we're always happy to discuss. And if it's more involved, we're always happy to refer you on to even more specialist advisors that focus specifically in this workspace. Until then, we hope you enjoy the other videos in this series, and we'll see you soon. Cheers. Bye.